With home prices so high, the question is, what's wrong with renting?
It's not a question. I mean, I think people, they solve to that monthly, right? Like it's the same thing with a car. People afford what they can, right? And I think generally most people, even though the landlords try to make it sound like why rent, or why buy when you can rent, and and there are people that do rent, but I think generally people should be buying a house, right? But right now they can't.
Right now they can't. So, but it is significantly cheaper to rent right now. So there is, some,
It's not going to get any better.
Right, but I'm saying right now it is cheaper to rent in a lot of big areas than it is to buy. So I do see the appeal for a lot of people on their monthly payment.
Yeah, well, they have to.
Mm-hmm.
It's not really much of a choice, right?
Well, kind of. But Jerry, pull up clip 1. So like in Austin, you have 141% difference in renting than buying. Seattle's 121%. Phoenix is almost 100%. I mean, these are big numbers, the difference. Like it's about half to rent than to buy.
Let's stay right here for a minute, Jerry, if you would. So the one thing I also want to point out are home prices, right? Like we don't have that on this chart, but it's important to know that some of those cities are extremely expensive. And, we all know. So Austin led the rental market by a long shot over the last few years. And what I mean by that is it was kind of the darling of, where a lot of people were moving. And so there was a lot of developers building apartments, et cetera, there. And the reason I bring that up is because now, as like everything, it's oversupplied. Right. Austin is oversupplied. And so you start to see these markets that potentially have these oversupply problems. Rents are flattening. Maybe there's some concessions even. Certainly there is in Austin. I know in Phoenix. Now, Phoenix is a huge market, as you can imagine, but this is where we are. We had our acquisition guy, James, go out last week to the west side, which is kind of near the Cardinal Stadium. So if any of you guys ever took a look at, where the Cardinals play, that's considered the west side of Phoenix. Well, he went out there, James, because we're looking at properties out there. It's a bloodbath. So what I mean by that is all these units opened up around the same time. Guess what they're offering right now?
Concessions.
Oh, yeah. Well, that's a given, but guess how much?
Couple months.
2 months free, $99 moves you in.
Mm-hmm.
So that's how competitive it is. So when you want to see a softness of a market, and this is temporary, of course, because it will get absorbed as Phoenix continues to grow. The question is, how long will that happen? And the only reason I bring that up, it's a small little spot in the country, of course, but it is Phoenix. And there are other areas of Phoenix that are doing really well. And so as you start to see the supply being added around the country, now, this is certainly happening in areas of Florida. It's certainly happening in areas of Vegas. It's certainly happening in Phoenix. And, we're starting to see Atlanta. We're starting to see kind of softness, certainly in lots of areas of Texas. That needs to be absorbed. And so from a renter standpoint, the renters have a lot more options. Imagine that you can actually move into a brand new property in West Phoenix for $99 moves you in. Now, in 3 months, you got a problem, right?
Right.
But the reality is you have a 3-month break. And there's all kinds of issues that can come from that. But so as you start to see these rents flatten, these are properties that broke ground 2-3 years ago, and they're trying to lease up now. And that's also helping with these numbers.
Yeah, and something has to give, right? Because right now, based on the current home prices, rates need to drop to about 5 to 5.25% in order for renting and buying to be comparable in most of these markets. And they're not happening anytime soon. And part of that is the expensive home prices, and part of that is the discounted rental prices that you were just speaking of. So essentially, something has to give, right? And that's why we're not seeing a lot of traction in the single home market, because for investors, it doesn't make sense. Nothing's going to cash flow. And for buyers, they're kind of priced out because the mortgage payment right now would be so high when they can comparably rent something that is much cheaper. So we are seeing this stagnation. So something really does have to give. So either housing prices have to come down or rental rates have to rise that makes buying more appealing. And that's why we're not seeing a lot of sales right now.
Rental rates are not going to rise in the next 2 years.
Right.
I'm telling you guys right now. Like, all you got to do is just look at the sheer number of volume of supply that's being added right now by market. Now, maybe it will in your little submarket somewhere. So, of course, I'm generalizing. But if you take a look, there's almost 1 million units that have hit in 24 and 25, and I think they're trickling into 26. Now, that's single-family condo projects, and yes, there are some of those, and apartments. They're all hitting all over the place, and the West Side is just one example. Not everywhere is 2 months free. I actually think that this probably could be as bad as 3 months free. When you get to 2 or 3 months free, you're not even covering your operating expenses.
Right.
I'm telling you right now. Like, because what percentage of that rent actually goes to pay for stuff, right? Property taxes, insurance, and especially insurance, utilities, all those kinds of things. They're basically just racing against the clock, all competing for the same tenant and giving them concessions to move in, because what they're trying to get away from is that construction loan. And the only way that a bank is going to let somebody off a construction loan is if that property's stabilized. So what's also interesting and to note is, I think, though, the people that are going to suffer the most are the independent owners that are trying to list their house and sell them right now, right? Because the home builders are doing big buy downs, right? So they have a huge advantage where they can take funds and basically buy down that rate for a period of time, whatever it might be. So it makes that monthly payment look really attractive to the individual. And so, ironically, what's really actually doing pretty well are brand new single-family home sales. What's actually lagging are existing listings, because, like, let's say I'm listing a house for $500,000 or $1 million, and I'm competing against a new home builder in the same market.
Right. That's willing to buy down the rate.
Correct. Right. And it's brand new. So you have that going on as well. That just throws a little wrench in all of this. But we just got done with our collective inner circle mastermind, right? I was in Dallas this week. I'm listening to George Gammon, listening to Jason Hartman, Russ Gray, and Robert Helms, and all my partners in this mastermind that we do. And Jason did a whole presentation on the single-family home market. And so it's very, very interesting, as you guys know, when you follow listings. And listings is supply. So it's important to understand, when the consumer has lots of choices, supply is high. And when they don't have a lot of choices, when people are, the people are driving to the houses and there's lots of different offers happening, that means that there's not a lot of choices. So supply is still at 50% of the average. So listings are at 50%. And the home prices are up over 400 on the average, of course, across the nation. And I don't see this relief anytime soon. It's going to be the rent. This chart is going to get even worse because the rents are just we're starting to see cracks in the rents. We're starting to get flat rents, concessions. All that's going to show up in 2025, which is precisely why I'm buying right now.
Because you're buying multifamily.
I'm buying multifamily, but I want to be buying when landlords, whoever they are offering concessions. I want to be buying when landlords don't have massive rent growth. That's the time to buy, because it will swing back if you just take a look at the math, because all this will get absorbed. But on the other side of that, if you put your single family hat on, I don't see prices coming down under 400. And there's
You keep saying 4, and I know everyone watching is, in Phoenix, in Scottsdale, you can't get a single family home under like 6.5. So you're saying 4 because you're calculating like the Midwest and things like that.
It's the national average.
But it's a lot more in a lot of other places.
If you look at the coasts, it's a lot.
Mm-hmm.
Yeah, the coasts are expensive, and the middle of the country is less. If you just want to be general, but so yeah, but if you if you just go on the St. Louis, is it the Federal Reserve, Fred? I think it is FRED. Just go look. You can see what's the average home price. I think it's over 400. So that's, you got to track something.
Yeah, it's 410.
410. So you can do that by market. You can do that, and you can drill down into your own market and see. But also, rents are going to be lower in those markets.
Yeah, and so we still advocate for buying instead of renting, even though it is cheaper right now to rent. So a lot of people think, well, since it's cheaper to rent, that's what I should be doing. But not necessarily, because, Jerry, if you could pull up clip 2. So the median home price in 2015 was $275,000. Today, it's $410,000. So that's a 49% increase in the last decade, right? So you're not getting this appreciation if you're continuing to rent, even if you're saving a little bit of money month to month. And if you look at AI, and Jerry, if you can pull up clip 3, AI is predicting that in 2035, prices of an average home across the country will be $600.
We got to get AI on the show.
Well, that's a 46.
Who is AI?
They take all of the data.
I'm joking. Come on.
That's a 46% increase in the next decade. So basically now, and that's a reasonable, amount, because we just in the last decade went up 49%. We haven't even had that much inflation in the last decade until the last couple of years. We think we're moving into another point of high inflation. So a 46% increase is not unreasonable, and it could be higher. And so if you're continuing to rent, you're not going to be taking advantage of this.
Well, another way to look at it is that if you own something, hard asset, it went up 4 to 5% a year for the last 10 years, and it's projected to go up 4 or 5% a year for the next 10 years. That's another way to look at it. So also, it's darn near close to 100% increase in 20 years, right? That's another way to look at it. So, of course, rearview mirror stuff doesn't mean it's going to happen through the windshield, but at the end of the day, what is going to offset home prices? Like anybody. Like I would love somebody that's watching to say, what do they think? Why do they think home prices are going to go down? I haven't seen any compelling argument for that yet.
I've seen some stagnation, right? We're definitely seeing stagnation. We're definitely seeing some lowering of prices in the single family home market, but it's nothing significant. And I think everyone is just waiting, because they either have tenants in there or they're living there themselves to get the price that they want. Right. So we are seeing some lowering, but it's not been anything like people are, this is going to go down 20, 30, 40%. We're not seeing that. Right.
Yeah. But if you own something today and it's rented, you better make sure that you lock that renter up for the next year to 2.
Yeah.
Because you're getting into a rent softness area. So if you're projecting rents to be increasing in the next couple of years, you got to be careful. We just bought a property. Actually, we just got it in escrow. You're the first to know. We got it awarded last week. And we're on the phone with the largest pension in Canada and the largest pension in Australia that actually own this property. A very astute question. The question was, what did you budget for years 1 and 2 for rent growth? Extremely important question. Because what I project for year 1 and 2 can significantly make a difference of the returns. So I thought it was an incredible question. And I said we actually budgeted for concessions and 0 rent growth.
Yeah. So it is always better to buy than to rent, because you're, getting some of that benefit. You're also able to pay your mortgage down over time. because all of this money that you're putting towards rent versus your mortgage is going to actually do something for you versus just being thrown down the drain.
True. There's no question. You are paying down your principal if you have that kind of a loan, for sure. And, again, we advocate buying assets. Don't get me wrong. But right now, the facts are what they are.
Mm-hmm.
The facts are, from a renter standpoint, well, let's put it this way. You're not going to pull a lot of renters out of rentals to buy homes.
Yeah, but if you're, so like say you're waiting for the market to go down before you buy, if you're paying $2,000 a month, that's $24,000 a year. So how much is that $400,000 or $500,000 home going down if you're paying $24,000 a year to rent? You know what I mean? Like, you have to consider that, because if you're going to wait 5 years, okay, well, that's going to be $125,000 that you're paying in rent that you could have paid towards your mortgage.
Yeah, and we're not going to see, Nobody's saying two points down on the interest rates. So when Danille said, right now we're around 7, let's say, on a mortgage, it's possible that the Fed, goes down a little bit, but everything I'm reading is maybe 2, 3, 4 times at a quarter point each, if we're lucky. But it doesn't matter if if home prices keep going up, if these values keep going up. The one thing that's going to offset pricing is supply. So we need low mortgage rates to spur new construction. That's what we need.
But I don't think we're really going to get low interest rates. I mean, Trump wants low interest rates. The Fed doesn't want low interest rates.
Right.
They're
creates
holding
inflation
steady.
again. Yep.
And people are asking, well, what if renting is cheaper because with your home you're paying what you're paying in rent for tax and insurance, But the truth is you're not getting the appreciation, because rates are not going to just drop all of a sudden back to 2-3%. So you're never going to get that appreciation, and you're never going to pay down your mortgage if you just keep renting.
Right.
And rents are going to go up. Like, rents are inflationary. So in 10 years from now, rents are going to be way more expensive. Where if you lock yourself into a fixed rate mortgage, even if it's more right now, it's probably not going to be more in 10 years, just from inflation alone. Right.
So 5% of $400,000 is $20,000. So if this trend continues, whatever it is on a hard asset, that hard asset could go up $20,000,
right?
Using those numbers, right? So, and then of course next year is compounded based on the higher number, so it goes up a little bit more than $20,000. But essentially, that's what we're talking about. We're talking about a $20,000 a year put.
Well, yeah, and everyone always says, "Oh, I wish I would have bought 10 years ago because it was $275,000 to buy a house," or like you hear that all the time. But those same people aren't going to buy right now, and then in 10 years from now, they're going to be like, "Oh, I wish it was only $500,000 to buy a house," and it's going to be $800,000 on average, right? So you're going to have that. It doesn't just stop. Everyone thinks like, looking back in time, we had the 2008 financial crisis, then we had COVID, and now prices are just going to dip back down, and that's what I'm going to buy. It's like, no, prices are going to keep going up, and you're going to be well off if you bought right now, but then if you wait 10 years, you're going to miss out again.
Yeah. So I went through 2008, and what offset pricing was supply. People walked away from their houses, and there was a whole bunch of listings. Went back to banks. And I think at one time we were in the 3 million listing range or something like that. So it was like 2 or 3 times what it is now. So that's what happened. And so again, the consumer has more choices. But I think there's 2 things happening at once. If you isolate the rent piece, rents are going to be flat for the next couple of years. Just telling you. So if you're trying to buy real estate and cash flow it, you're not going to have significant rent growth.
Right.
The other thing is on the single family side, rates I think aren't going to change that much, and I don't see rent or home prices coming down under 400. Right.
Mm-mm.
So And so what offsets that? Could be a lot of listings. A lot of listings would certainly help bring pricing down. That's essentially, if you take a look at where there has been some reductions in single-family homes, it's been precisely because the days on market have gotten long. And so also, don't forget, as a seller, they're looking in that rearview mirror. They're saying, oh, my house was worth this. It's gone up by this much. And so I know personally there's a lot of listing agents that have been frustrated because the sellers want to obviously maximize the sell price of their home. And so just because something goes down on the MLS doesn't necessarily mean that it's a pricing problem. It is a pricing problem, but it doesn't necessarily mean that it wasn't mispriced in the beginning.
Mm-hmm.
Sometimes
Correct.
they do that just to get a listing.
Right. Yeah, sometimes they overprice, right?
Correct.
So when you see something drop, you can't just say everything's dropping.
Right.
Was it priced reasonably to the start?
Right. So, but it's going to be an interesting thing to watch because the industry that's actually doing quite well right now is the single-family home builder because of this buy down.
Yeah.
Right. And even though it just might be a year or something, it's getting people into homes, and you're starting to see some sales there.
Yeah. And Jerry, if you can pull clip 4, part of the reason that, we're not seeing home sales is because it's so expensive, right? So we're just going to say the average price is around $500,000. You have to come out with your down payment, which in the U.S. is on average 13%. So we'll say $65,000, and you have an interest rate of 7%. Your monthly payment is almost $3,000, and that's before tax, insurance, and HOA,
right,
and repairs and everything else. So that's super expensive. So and if you really look throughout the years, right now, average income versus average house price is 7.25%.
Yeah.
The amount. Where in 2006 it was 6.8. 2016 it went down to 5.5. During the recession. But 7.25, that's a lot. The average income, it's over 7 times the amount to buy a house.
And let's don't forget, you kind of touched on it. There's a really good study by Bank Rate. Just type in Bank Rate and look for the cost to own a home study. And I'm going off of memory, but I think it was $18,000 was the average cost to own a home. Now that's everything, right? And this is non-mortgage. So it's about $1,500 a month to own a home. Now, of course, it's all sliced differently. So if you have a 700 square foot condo, it's not going to apply, But the reality is you've got your taxes, you've got your insurance, you've got your maintenance, you've got your CapEx or your capital expenses for things like the roof or the paint or whatever it might be. Just little repairs that come up here and there, and sometimes not so little. So you have all of those things, and it's a really interesting study. So when you take the almost $3,000 a month for the mortgage at 13% down plus the $1,500, you're actually looking at well into the $4,000 a month range to live in a $500,000 house, right? So I think that's important.
Yeah.
Right?
Yep.
So, and so then you take a look at what will that rent for? What will that $500,000 house rent for? And that's how you actually have to back into stuff because it's just math.
Yeah, and the big thing really, like median income versus median house price, that's an important metric to look at because that really defines affordability.
Yep.
Lyle has a question here. He said, I hope rents aren't flat for 2 years. I need to increase mine to keep up with utilities, tax, insurance, etc.
That's a heck of a point.
Wouldn't rents be more localized based on supply and migration?
You're right. They definitely are localized. So it just depends on where you are. But if you're, there's pockets in Austin, pockets in Houston, pockets in Dallas. These are markets that I'm in. Pockets in San Antonio, pockets in Tucson, pockets in Phoenix that are soft, period. There are also areas that are really, really, really good. So we just bought or about ready to buy a property in Scottsdale. It's 300 units that we got awarded last week. And Scottsdale is really difficult to build in. And there's definitely some supply coming in Scottsdale, but it's not that much. Same thing in Tucson, our Mason Ranch project, where we're going to build. There's not a lot of construction over there, and there's not going to be in Tucson. So now on the other side, there are definitely areas that are like in Frisco and Carrollton and Plano and Texas, let's say, or on the West Valley in Phoenix, and you're going to see areas that are overbuilt. And same thing in Austin. So those are going to be markets that are going to have to work their way through it. And the market is somewhat inefficient where, when all these units get dumped onto it, the only thing that cures it is people moving to the area. And what messes with it is when they move out. So, yes, to answer your question, it's possible that your market could see rent growth. If it's undersupplied and there's a lot of people moving there, then you're more than likely going to see a little bit of rent growth.
Yeah, I mean, I just listed one of my units, and I'm definitely seeing the challenges because normally my units rent really, really quickly. This one has not, right? So I'm having to, look at alternative options and do shorter term leases and kind of try to work with some tenants in order to
let's talk
get
about
it filled.
that. Yeah. You're a great example. Danille has always had very good success of getting another tenant in there right away. Like,
no vacancies.
Like, it's unbelievable what she's been able to do. She's actually stressing out a little bit about one of her units.
Yeah, I have a unit, and it's a condo, so it's similar to like a lot of the apartments that were built, except older.
In Scottsdale.
In Scottsdale, great location. But, I've had some issues filling it, right? Like, I'm not even getting the showings because people are looking at the concessions. They're looking at the rental prices. I've already lowered the rent 10% from my last tenant. Might have to lower it more, And so you're kind of getting, and as a small landlord, you're like, well, do you just wait it out so you get somebody? But then every month is costing you so much money, right? So you're kind of looking at that. So I'm looking at different options, shorter term leases, people that are remodeling their houses, stuff that, a year ago I would have been like, no, it's like 12 months or 18 months and that's it.
Right.
Now I'm looking at 4-month leases. What I'm not doing, and landlords out there, what I'm not doing is I'm not conceding on the type of tenant that I want. I'm not conceding on credit and background checks, but I am conceding on, the terms and maybe, even the amount that I'm charging.
Yeah. And that's all. So hopefully you're in a market that doesn't have any of that softness. The weird thing is because we live in Scottsdale, or actually Paradise Valley, there's not a lot of development in Scottsdale.
Right.
It's not like this is a market that's, because Scottsdale does not particularly love new housing, which is part of the reason why it's expensive here. And so this could be the case in your market. And her unit is in Scottsdale, and she's having challenges. So now, if you go out to another area, like let's say Chandler or Gilbert or Peoria or Glendale, let's say, you're going to have a very different scenario.
Yeah.
Right? And of course, if there's been lots of construction out there, like there has been on the west side, then you're going to see that softness for a longer period of time. Essentially, you only have so many people trying to figure stuff out. They're trying to rent somewhere, and and as the listings grow, their choices grow. This is precisely what's actually good for the market. Danille's had it really easy over the last few years, but this is actually more normal.
Yeah, absolutely. And, I'm having to do things and post things places and physically put signs up and things I've not had to do ever before. But Travis is asking, how much should we be thinking about tax write-offs when considering whether to buy or keep renting? Does higher cost of living areas matter more than lower cost of living areas?
Yeah, so for me, it always boils down to the same thing, and that's math. And so there's two real wild cards that one is most of the markets that we're underwriting, you have to be careful that you don't underwrite significant rent growth or significant value add. So, as you guys know, a couple of years ago, we stopped doing value add because there's an affordability problem. Let's don't forget about that. Rents have gone up a lot. And so what we'd call a classic, or something that had maybe 20 years or 30 years, we've just changed out some carpet and painted it, let's say. We kept them as classics because that's now the new affordable. So you got to really be careful on how you budget your revenue. On the expense side, to your point, the wild cards are insurance. We all know, we did a podcast on the California fires. We've been hammered personally in this company with insurance costs. And those insurance costs, prior to that show, prior to the California fires, people were blaming the hurricanes in Florida. They were blaming the fires in Hawaii. They were blaming the fires of the previous fires in the Malibu area, let's say in California, and some other things. So a loss in whatever capacity in a company like, big national company, it doesn't matter which one, they take on that loss. It doesn't matter what state it is. So I guess another way to say it is you're paying for everyone's loss, and that's how they spread it around. And so this is going to be a big hot topic. It's not just because the loss was in California doesn't mean that that insurance company, whoever they are, is going to isolate all that stuff to California. They're going to spread it amongst
even though it's illegal.
Yeah,
they're not going
trust
to.
me.
I know we're going to get comments. Well, it's state by state. Well, of course, but they're
You guys,
going to come up with reasons to up it in other states.
You just watch.
Yeah.
And then you're also starting to see property taxes go up a lot. So at this conference I was at, I was talking to some folks that are doing some build to rent out in the East Coast, and their property taxes have doubled. So property taxes are going up and insurance is going up. We're also seeing energy costs going up. We all know that labor, who knows, but it's probably going to go up a little bit. It has gone up a little bit. And so things are going up. And so it's just math.
It is just math, but you always have to remember, on a 30-year mortgage, you're at a set rate. As inflation hits, and inflation is going to hit again, everything Trump wants to do is inflationary because it boosts the economy. And it's like if you're in a set mortgage payment that you can afford, and then people's wages start going up and expenses start going up. If you look at countries that have high inflation, wages go up too. Like wages go up, expenses go up, everything goes up. But then even though your wages are going up, it doesn't necessarily cover the cost of the new expense of all the different things. But if you're locked into a 30-year mortgage, you're saving yourself. You're protecting yourself against that inflation.
You're hedging inflation.
You are.
Right.
And in most countries, you can't do a 30-year mortgage. Like that's something people don't realize is most countries don't offer that. They offer like 5-year and then it resets the rate. So you might be able to get a 30-year mortgage, but the rate resets every 5 or 10 years. In the U.S., we've been really fortunate to have this 30-year mortgage option. And, not everybody understands that or takes advantage of it.
Right. Yeah. So that's precisely what's happening to a lot of these commercial properties, as you guys know, is the loan matures. So, and as the loan matures, it matures to whatever the rate is, prevailing rate now. And I think that I just looked at the 10-year before we got on here. It was like 4.6. It's come down a little bit, which is good. But rates are actually up a little bit right now.
Well, and we're going into this high rate time, and all the predictions we've seen on rates is that they're not really going to go down very much, if at all, the next year. Even if the Fed is cutting because of the 10-year, it's still not going down. So the Fed can only do what they can do. You look at that, like the 10-year is a problem for rates to go down, even if the Fed decides to keep cutting.
Right. I'll keep this up for a minute, Jerry. I think it's important for people to see that back in September and October, the 10-year was, at 3.6, 3.7, let's just say, between and now it's up at 4.63, it looks like. And so what does that mean? There's a spread on top of that, and of course that can be an adjustment, but at the end of the day, you can see where rates are. And it's really, really, really interesting because, by the way, this is not the federal funds rate, which is what a lot of people focus on. that this is different. But this 10-year is what a lot of loans are based on.
Mm-hmm.
So the 10-year is up. So let's just look at the multifamily market. If I was buying something in December, you can see how much different it is today, right? So even though the property value might be down, the loan is up.
You mean December 2024?
Yeah, December 2024, which is, by the way, 45 days ago. So, right? So huge difference. And so the 10-year is important. And, it makes a significant difference on whatever it is you're buying. And so that also gets you further and further and further away from cash flowing, right? Because your rents are the rents. Like, the rents are not moving like that. The loan prices are moving like that.
Yeah, absolutely. And it's just going to be, so, even though, it is cheaper, you do have to look. It's more than just the number, the month-to-month number. But I do think it's interesting because a lot of people can't afford to even buy because of that down payment, because of qualifying. And JT from YouTube said, buying should always be the default approach for an eligible, regular person with a simple income.
Agreed.
Anyone with access to substantial amounts of money, there's wiggle room to go either way.
Yep.
I agree with that, because if you make a lot of money and you have a lot of money and you want to do alternative investments and, paying a few grand a month in rent, it doesn't really affect your net worth either way. That's a total fine way to look at it. But most people are paycheck to paycheck to paycheck, scrapping by, trying to make it work. And, when you go to retire and after 30 years, your house is paid off, that's going to go a lot longer of a way than, you took a little bit of money every month and tried to invest in the stock market. Like, that could be great for you, or it could be not. You really don't know. And one thing you do know is if you don't own a house, you're going to keep paying rent into retirement.
Right. I don't see a lot of relief through 2025 with this. I mean, maybe you'll get a little bit of relief on the interest rates, but you're also going to have rising house prices, in my opinion. And rents are going to be flat in most markets that I'm looking at least. And so, with that being said, we could be sitting here 1 year from now with higher house prices, maybe a little bit lower on the interest rates, but rents are not going to move that much.
Right. Yep.
So, we can look at this month by month, but at the end of the day, at the end of the year, my expectation would be home prices will be up. Interest rates might be down a little bit, but rents are going to be darn near the same.
Yep. But you do think in the next couple of years, once the supply is absorbed, rents are going to go back up.
Oh, for sure.
Yeah.
It's just, again, I've seen this over and over and over. Low interest rates spur development and construction. That's precisely what's hitting right now. There's a big lag with the construction, right? Mm-hmm. So it could take a year and a half to open a clubhouse for a new apartment complex, as an example, and then another year to lease it up. So you're looking at 2 to 3 years before you're even stable. And so that's what's hitting right now. So anything that's hitting, let's say in 2020, late 24, early 25, started in 21, 22. And so that's all this is. And the same thing with a home. Single family homes can obviously get built quite a bit faster. But once the infrastructure is in, once the utilities and the roads and all that stuff is in, they can knock those out pretty fast. But with a lot of rentals, there's especially on a big scale like these big condo projects or multifamily, the lag's a little bit longer.
Yeah, and it is good time, if you have a good real estate agent that you're working with, it is a buyer's market right now. I mean, it really is. I mean, it's not a great buyer's market. It's kind of like even and a little more of a buyer's market than sellers. So if you're looking for a home right now, it is the time to make those lower offers. Try to negotiate, because people that are selling, some of them have to sell because divorce, relocation, lost their job, etc. So now's the time to try to get a home for a better deal than it's listed for.
The 3 Ds. Mm-hmm. Don't forget about the 3 Ds: divorce, death, and debt.
Yeah,
those are the 3, and they're going to happen regardless.
Mm-hmm. Yeah, and so it's a good time. It hasn't been a great time to buy the last few years because it's been such a hot market, but now it's kind of turning that way. Rocky is asking, cash flow seems to be a thing of the past for us investors. What's your thought of breaking even on a rental?
No. I mean, Danille and I argue about this. I mean,
we don't really argue.
Over a glass of wine.
Well, no, and I don't think you should break even on a rental either, because expenses keep going up and rents keep going down. I mean, even on my properties that I'm not break even on, I'm now having to lower rent $200 or $300 a month. I'm still not break even because I had a nice cash flow, but now my cash flow is $200 or $300. So if it was breaking even, I would be negative, and if I was only cash flowing a couple hundred, I would be negative. So
under the bus you go.
Yeah.
All right. No. Let's talk about the last deal you just bought.
Oh, my last deal? Yeah, it's negative now.
I told her. Did I not tell you?
Yeah, you did.
I said, don't do it.
Well, I don't know if you said that.
1,000%.
I don't know if you said that. I think you said
she got it to net. I go, listen, don't do it. The whole point of investing in real estate is to cash flow. So now, by the way, you had to go through the lesson, and I know you were just squeaking by, but now what's happened is the market changed.
The market changed, so I'm a couple hundred negative
right.
now.
So we're talking about, the question was, would you buy something that doesn't cash flow, even if it breaks even? And the answer is no.
Yeah.
I mean, what is the point?
Well,
I'd rather have money in a 1-month T-bill.
It's less fun because now when you're fixing stuff, it's coming out of your pocket versus, the savings account that the rental is providing, to fix the things. So, and it just becomes a burden. And then especially if you're tight just financially anyways. So now, you would be feeding that and it would be affecting your day-to-day life.
This is where the lessons start. Mm-hmm. They start when you're writing checks. And I've just been through it before. The things happen. People move out. Vacancy goes up. Expenses go up. Your loan matures. You got a capital expense. You need a new roof. Whatever it is. There's things that happen that take from the cash flow, and you don't want to be. You don't want to just be above the waterline. Because just to get in the game, you'd be better off doing a 1-month treasury at, what is it, in the 4s, I think, and just getting 4% on your money.
Well, then the other thing too is that you need to plan. There's no planning when you're not cash flowing, right? You're just coming out of pocket, and a lot of landlords are going to be squeezed from this in the next few months. So you might be able to get some of these deals that are break even. You might be able to offer lower and get a deal on it. You might be able to wait and those go down, because what I can tell you is a lot of people that bought in the last few years, especially Airbnbs, and they're negative, right? Like every month they're super negative. And so they need to get these properties off their books, and they might take a very low deal if it's been sitting for a while, especially if it's been sitting over 60 days. Yeah. I would make a low offer, because why not, right? Maybe you can do your cash flow to where you're cash flowing a few $100s a month, and whatever that is, that's the number, and they need to sell it for that in order for you to buy it.
Yeah, if you own stuff, you're going to have a little bit of pain this year, I'm telling you, because of higher operating costs, and it's going to be tougher to keep your tenants. So if you do have them, covet them, be nice to them, renew them. Do whatever you can to keep them. You want stable cash flow. But the last thing I would do is go into the market today anticipating that things are going to change operationally in the next couple of years.
Well, and a lot of people keep asking about house hacking too, and that's something we didn't really touch on, but I would like to. So, if you buy a house and say that it is double, we have people on here saying it would be double for me on the payment. Is there things you can do to offset the payment? Can you rent out rooms in the house? What can you do for you to be able to buy a home and get in on this great investment without having to come out double the cost?
I still love the house hacking strategy.
Yeah.
Because really what you're doing is you're eliminating the renter is covering your expense.
Right.
And you're living ideally on one side for free, right? That's the traditional house hack.
Yeah, if you have, 3 bedrooms and you rent out 2, ideally it's covering your home mortgage. With prices so high now, I don't know if it will actually cover your whole mortgage, but even if it covered 2/3 of your mortgage, and now it would be the same prices to rent as to buy, or it would be a little cheaper. Yeah. Now it's making sense, right?
The other thing is, I will tell you, affordability is a big thing moving forward, even with the softness of the rental market. So anything that you can do to help somebody, your friend just went through this in Austin, right?
Mm-hmm.
Where she rented a room.
Yeah.
And rented it for a really reasonable price, significantly less than a 1-bedroom, right? It's a win-win.
Well, it was win-win because they rented, 2 rooms in the house that way. So it really offset their mortgage. And, I think the owner of the home was disabled. So it just really helps, So it's a win-win for the tenants and it's a win-win for the person who's home. Just make sure you're still doing all of the correct credit and background checks just like you would on a normal renter in a house hack.
Yep, because they are living in your home.
Yeah, they have the same tenant rights as if they were living in a condo.
Yeah.
So, So Lyle is asking, where would you guys draw the line on a bad tenant? Would that be as always late on rent, or they can't pay for, rent every month, or a drug issue, or like what's the line that we look at?
Yeah. So it's pretty black and white when we run a criminal credit background check. We also run a sex offender check on every single tenant that we would ever let in. Now, that's not to say that there can't be issues once they move in. But we have a really, really crystal clear lease that says that when they're late, and then there's a fairly significant late fee. And you have to decide on whether or not how much you want to accommodate that. So for us, we don't. In other words, if they're late, we serve them, and then they pay, and then that goes away. So we don't take partial payments. We don't let that go 30 days, all of those things. Now, you have to do it within the laws, but the laws are if they're late, you can serve them, and that starts the clock, and you got to start moving down the road. So the tenant needs to know that you're just going to treat them the same as you would anyone else. You don't want to make side deals with people. Just make sure you treat everyone exactly the same way.
Yeah, absolutely. And, we run all the credit and background checks. And I think you might have been asking on once they're already there, right? So for me as a smaller landlord, if somebody is always late, it depends how late. If somebody's always a day or 2 or 3 late and they always pay the late fee and there's no drama involved, I would still renew them. Because to me, it's like, okay, you're paying the late fee, whatever, right? And I've had tenants like there's drama involved, right? I don't know when I can pay you. I just lost my job. I just did this. And it's always something, right? It's not like a one time in the course of the year. It's all the time. I don't want to deal with that drama. So that's when I draw the line and I say, I don't know if I want to re-rent to you, because I would rather find someone that just pays and there's no drama around paying,
right.
And then for me too is sometimes you get high maintenance tenants, right? And with the high maintenance tenants, I deal with that a lot too, where everything's an emergency, everything's not right, everything's this. So it's just up to you on like, do you want to deal with them or not? You know what I mean? Do you want to go through another year of dealing with that as a small landlord, or would you rather find somebody else, maybe make a little less money depending on what rents are doing in your area, and not renew them? So
well, you have a 90-day notice period, right? 60, yeah. So we have 60s and 90s. So you do have the right as a landlord not to renew somebody.
Yeah.
And just like they have the right to not renew. So you could, if you are having all kinds of problems, obviously say, listen, we're not going to renew your lease, and we're going to move a different direction. And
I wouldn't go into why. You don't need to go into why. You don't have to renew it. I would just decide if you want to or you don't want to renew it. I've always renewed people's leases because I've never had such an issue that I wanted to not renew. But, and also if, you're getting a lot of complaints from neighbors. I had that one time where they were partying a lot, and luckily they didn't want to renew, but I probably wouldn't have renewed them because it was just causing me, whatever causes me problems, I don't want to deal with it. If they're being bad neighbors and so I'm getting complaints from the HOA, I'm probably not going to want to renew them either.
I'm telling you, you guys should make sure you just all document it, right? So if there's calls from the let's say the local authorities, the police, or stuff from the HOA, or whatever it might be. Maybe there's damage. There could be all kinds of things. I've had situations where there's I had a drug dealer. We've had prostitution. Like, you'd be super surprised at what goes on. maybe you wouldn't. And so, you have to make sure that that's all documented. And there's nothing wrong with confronting the tenant after that stuff is discovered at all, and I personally, I think it's within your rights to say, listen, we've had a bunch of calls from the local authorities here, so we're just choosing not to renew the lease. That's something that you can do. It needs to be in your lease.
Yeah, and Dow is asking, can you let us know what a significant late fee is? I have 2 tenants that are late every month.
Yeah, so they should be in the hundreds, in my opinion. So you can make it whatever you want. Now, statutorily, I think there are some restrictions, so you have to check with your state. But $1,000 rent should be at least $100, period, right? And then we also used to have I don't know if we do it anymore. We used to have like a $5 or $10 a day as well.
Yeah.
So, but again, you have to follow whatever the state says it's for. So first look there.
So one thing I learned the hard way is that you want to charge a daily rate. So whatever you do, it needs to be a daily rate. I do $30 a day. The problem is initially I did $30, Well, then if somebody's late on rent, they're like, okay, well, like, I'll pay you on, the 15th, because they're not in any hurry, because there's no consequence to them if they're 1 day late or 5 days late. So when you do a daily rate, they're at least motivated to get you paid. And so I definitely made that mistake, and I definitely have corrected it since. But it was frustrating with my tenants that were always late because, it was $30, right? So they just paid late every month and paid me $30,
Yeah, we don't have a lot of late tenants, believe it or not, even with 10,000 of them. Trust me.
Yeah. Well, money's a good, paying, they don't want to pay.
Tight. You gotta have a fairly significant hammer for late payment, and make sure you don't waive it.
Yeah.
Period. Do not waive it. So if somebody, I'll give you an example. If the rent's $1,000 and the $100 in late fee, and they're like, I'm not paying it, and they give you $1,000, and you deposit the check, then if you have 2 options. Option 1 is you waive it, which is a huge mistake.
Mm-hmm.
Option 2, you apply the check toward the $1,100 balance, and the balance is rent.
Mm-hmm. I
want to say this again. The balance is rent. And then what you do is you immediately turn around and you file based on that $100 of rent still owed. That's how you do it. So you can't collect on a late fee. So if you apply the $1,000 against rent and then say you still owe for the late fee, they're going to win. So you apply the $1,000 toward the late fee plus the $900 of rent, and then you file based on the $100 of rent, because you can't evict on non-rent.
Mm-hmm.
So it has to be rent. The rent has to be the balance. And so that's how you do it. And you just follow the system. It doesn't matter who they are. It has to be the same across the board for everyone.
Absolutely. You can't waive for some and not for others.
Correct.
You have to do it all by the book,
right.
Which is why you shouldn't waive, because it should be all just, All right, guys. Thank you for listening, and we'll see you next week.
Cheers, guys.